Boons.
Thank you, Mr Speaker. I'd like to acknowledge first the role that Craig Foss, as Chair of the Finance and Expenditure Committee, himself played in this bill, and it did indeed steer through the Select Committee well. I don't want to go too far. I'd like to comment about the background to the bill, about a particular aspect of it which, as my colleague David Cunliffe has indicated, we as the Labor members on that committee will be watching to ensure that it works in the way that the Reserve Bank has assured it will work, and to look at a missed opportunity in respect of this bill also. The background to this bill was, of course, the collapse of financial markets 2 years ago in the United States, spreading across the rest of the world. And of course, we have seen in this country moves to reinforce regulation around how banks and financial institutions operate. And of course, it left the question of where the insurance industry was. And indeed, although the insurance industry itself in New Zealand was not in any distress, the global financial crisis illustrated very clearly the vulnerability of the financial sector as a whole, and hence this bill emerged through that process. The bill requires all insurers operating in the New Zealand market to be licensed and supervised by the Reserve Bank and to comply with minimum Prudential requirements. Compliance is going to be largely self-administered under the bill, but the Reserve Bank has an important supervisory role. And the Labor Party supports the bill, but one comment we would make is that it doesn't go far enough dealing with one of the key economic issues that we face as a nation, and that is the need to put exporters at the centre of monetary policy. And if we needed a further illustration of that today, I guess it came in the announcement, not unexpected, from the Reserve Bank Governor that we're going to see the official cash rate go up another 0.25 basis points to 3%, a not unexpected decision, but one which reflects back on our current monetary policy settings. Indeed, the Reserve Bank Governor has little choice. Given the focus of the current Act, he must reflect his concerns for the future rise of inflation. That's the only policy setting he has to pay any real regard to, and we note only in the last 3 weeks the Prime Minister was in my electorate in Christchurch Central addressing a forum of exporters in which he stood up and said, with some audacity I'd have to say, that the monetary policies of this country were, quote-unquote, the best in the world. And if the best in the world means that our exporters continue to get shtick because of the settings of monetary policies, that we see dollars, we have indicated very clearly, Phil Goff has given a speech which the Prime Minister chose to pan, that we should be looking at monetary policy settings, and we can be, we have indicated a wish to be bipartisan on many measures within this bill, but we can't let it go without any commentary suggesting that if we're going to be bipartisan on the future of the insurance industry, then why can't we be bipartisan on the monetary policy which the exporters of this nation are telling MPs like Jonathan Coleman every day in his electorate that it's actually screwing the scrum in respect of their capacity to export and earn for this nation. There is no one magic bullet on monetary policy, but there is a need to review the settings, as Australia has done, and we often, from the other side of the House, hear about how we want to catch up with Australia. We've indicated in the last couple of days, of course, how well or not we're doing in respect of that. But the Australian Reserve Bank looks at a number of factors, including the inflation rate. It looks at the whole issue of the state of the economy. It looks at employment. It looks at the dollar. It looks at the health of the economy. Those are important factors when we are considering the role of the Reserve Bank and monetary policy settings. And therefore, we say this was another opportunity which the government has missed, where it could have widened, could have looked at the issue of monetary policy and taken a decision to review this current obsession with inflation. Not that this is not a crucial factor in economic settings, but you can't play the whole game on one ruling. And that's why we say we had an opportunity here. And the opportunities are still in front of the government, and it is disappointing to see that when Phil Goff gives a speech which says we could consider a review of monetary policy, there is an instinctive response to that to bag it, and the Prime Minister has the audacity to stand up and tell a Canterbury exporting audience that the dollar at the monetary policy setting is the best in the world, and we see the results today with presumably a rising dollar and rising interest rates. Well, let's return to the substance of the bill, which is indeed around the issues of prudential supervision of our insurance industry. And one of the key elements of the bill is around the impacts on New Zealand and overseas insurers who are covered by the extension of prudential frameworks, and most particularly the questions around whether this bill would disadvantage New Zealand-based insurers who are subject to the regimes, whereas an Australian or an insurance company based in another company which meets the agreed requirements of the Reserve Bank can operate under the prudential regime of that host country. And I do have to disagree, in part at least, with the Minister of Finance, who affirmed in his commentary on the bill earlier that there was no real cost involved for our insurance companies to meet this bill. We did have a submission from AMI Insurance, which is New Zealand's largest New Zealand-based insurance company, which suggested that the cost of meeting the new prudential regime, meeting the cost of those new capital adequacy ratios, was of the order of $35 million, which is not a sum to be sneezed at, even for a relatively large corporate like AMI, which I think most New Zealanders would acknowledge as a very good insurance company, wisely based in Christchurch Central electorate. We were assured, however, by the Reserve Bank officials, and the committee spent considerable time on these issues, that the regime as proposed in the bill was not going to disadvantage New Zealand insurers, that there were going to be exemptions, there are exemptions in the bill in relation to a number of clauses for overseas-based insurance companies, but those would only be granted if the insurance company operating from overseas was subject to home jurisdiction in relation to that met the standards of the Reserve Bank, and that taken as a whole, the regime that those foreign-based companies would actually meet the standards of the Reserve Bank's prudential regime. We did, as I mentioned, did have some concerns still expressed by entities including AMI, who noted the difference in capital adequacy ratios between Australia specifically and New Zealand, quite a difference on various aspects of investment. But we will be monitoring how this works. We'll be wanting to see if the Reserve Bank's assurances are in fact borne out as the legislation takes effect and the industry makes its changes. I mean, obviously one of the great concerns is that we have at the moment a great bleed of capital goes on. Our current accounts balance has never been in the black since I was a schoolboy, which is a wee while ago, and we will be obviously watching to see whether overseas-based insurance companies do come back and use the bill in respect of whether they can take further insurance monies back out of the country. That should be a concern to members opposite when we do have a current accounts balance which has been in the red, which is heading further into the red. This is an issue that New Zealand Inc. needs to take note of. We know that we need to have regulation of financial markets. Labor's never been shy of regulating financial markets or any markets, but some members opposite don't believe in regulation. They say the market will always rule. Good to see we can get some consensus, some bipartisan approach.
A point of order, the Honourable Steve Shepherd.
I'm sorry, Mr Speaker, but I cannot hear my colleague even speak with the interjections coming from the opposite side.
That's a fair comment, and I have raised this point before, that we should be listening. If you want to interject against the Speaker, that's fine, but this cross-barraging of other points that have got no relationship to the debate are unacceptable. Call Brendan Birds. You have 1:10 remaining.
Thank you, Mr Speaker. As I was saying, the point about regulation is it needs to be judicious, it needs to make sure that it works in the interests of New Zealand. And so we will be watching to ensure that the exemptions that have been provided by this legislation to overseas insurers do not do so at any disadvantage relative to New Zealand insurers, which have to meet the New Zealand Reserve Bank's requirements. On balance, that was the decision the committee took. The exemptions that are in the law in front of us are there because a strong argument emerged about not duplicating regimes in one country and another. We were advised that the duplication from the Australian regime, for example, would be inappropriate to have it in both countries. So we've accepted that.